Then finally in part F, you need to comment on the dividend policy of Bulletin, and that's for 7 marks. All right, so obviously before we can comment on their dividend policy, we need to know what their dividend policy is. So if we go back to the information provided in the scenario, in the additional information you were given the dividends for 20x6 and for 20x5. And we also have the extract from the statement of profit or loss and other comprehensive income, which gives us the profit for the year. So if we have profit for the year and we also have the dividends for both of the years, you can either calculate the dividend payout ratio or the dividend cover. So as an alternative, don't perform both calculations. Either calculate the dividend payout ratio or calculate the dividend cover. If you're calculating the dividend payout ratio, you take the dividend and you divide by the company's profit for the year. On the other hand, if you are calculating the dividend cover, that's just the inverse of the dividend payout ratio. So instead, you take profit for the year and you divide by the dividend. Now, if you perform this calculation for 20x6 and for 20x5, you are going to get a dividend payout ratio of 20%, or as an alternative, a dividend cover of 5. So the dividend payout ratio tells us that they are paying out 20% of their earnings as a dividend. On the other hand, the dividend cover ratio tells us that their profits cover their dividends 5 times. So based on the information provided for 20x5 and for 20x6, we can conclude that they maintain a constant dividend payout ratio or a constant dividend cover. That is their dividend policy. Now we can comment on the dividend policy, now that we actually know what it is. Now, if they are maintaining a constant payout ratio of 20%, that means they are always paying out 20% of their earnings as a dividend. So that means dividends will track the performance of the company. If the company does well and profits increase, dividends will increase. If the company does badly and profits drop, dividends will also drop. And exactly the same logic applies to the cover ratio. Now, the problem with this, obviously, is the dividend is going to fluctuate every year with earnings, so it lacks stability. Now, ideally, we should compare this dividend payout ratio or the dividend cover to a similar company or to an industry average so that we can determine whether this is reasonable or not. However, we don't have that information, so we can't make that comparison, but you should still include that as a discussion point in your solution. And based on what we have calculated over here, I would say that they have a conservative dividend policy because only 20% of their profits are being paid out as a dividend. That means 80% of the profits are being retained in the company for future use and for growth purposes. So that's obviously positive. They're not just paying out everything as a dividend, they are keeping enough money in the company to fund future growth. However, despite the fact that they have a conservative dividend policy, there is still a risk that profitable investments will be rejected in favor of dividend payments. What do I mean when I say that? Because they have a constant payout ratio, every single year they are going to pay out, or based on what we can see over here, they are going to pay out 20% of their earnings as a dividend. They don't first consider whether that money could be used for profitable investments. What they should be doing is they should be looking at profitable investments, so in other words, investments that have a positive net present value that are going to create wealth for the company, and they should be investing so that they can grow the company. Then any residual that is not used for investment purposes can be paid out as a dividend. The fact that they have a constant ratio and are just paying out a constant amount every year means that they are not first considering whether the money should be used for investment purposes. So that's obviously a risk. And the problem with that is if they are not keeping enough money in the company, if they need to raise new equity finance in the future by issuing new shares, that's going to cause a dilution in control for existing shareholders. Then another point that you can discuss, remember, accounting profits and cash flows are not the same thing. Accounting profits, or the statement of profit or loss and other comprehensive income, is prepared on the accrual basis, and it doesn't only take cash flows into account. So just because the company has made a profit and they're paying out 20% of their profit as a dividend does not necessarily mean that they have enough cash available for that dividend payment. So they always need to consider whether there is actually enough cash available for the dividend payment. Just because there are profits available doesn't necessarily mean there will be cash available. There's a difference between profits and cash. In addition to that, they should also always consider shareholder preference when it comes to their dividend policy. What do shareholders want? Do shareholders want an annual dividend every year? Or would they be happy for the company to rather retain the money and use the money for capital investments which will grow the company, and then obviously the shareholders will benefit from a growth in the share price? So shareholder preference should always be considered when determining the dividend policy of a company. Then lastly, given the current economic environment, and I've said that a few times, but obviously you can see based on the scenario it is very important. Given the current economic environment and the fact that they are operating in a declining industry, the print media industry is declining. Yes, online media is growing, however, they are not yet actually in that market. So given the state of the economy and the fact that they are operating in a declining industry, they should consider whether they should actually be paying dividends at this point in time, or should they rather be a little bit more conservative and keep that money back just in case they need it within the business. All right, so that's what I was looking for in part F of the required. Okay guys, I hope you enjoyed doing this question. I really enjoyed setting the question, so I hope you enjoyed doing it. Thank you very much. We are done.